Hello and welcome to the Saturday Summary for October 4th of 2014, your weekly summary of market and economic news for annuity and life insurance professionals. I'm Jonathan Ilga of Brokers Alliance here for The Biz. Well, the fourth quarter began on a flat note for the broad indices following a generally positive third quarter. As we see here, the third quarter was positive for the large cap indices and the NASDAQ, but just brutal for the Russell 2000 small cap index. Looking back at the month of September, all the U.S. indices that we track were negative for the month. Again, with the small cap stocks getting hammered downward, while the large caps and the NASDAQ were down, but not substantially for the month. Well, this week saw consecutive down days in the indices until Thursday's reversal, and then a 1% plus rally on Friday. Now, overall, this could signal the start of a trend or sentiment reversal in the markets. But of course, as we know, since the onset of now years of central bank intervention in the bond and equity markets, a lot of the old rules no longer apply until they will again. Well, our summary headline this week is mixed signals. Now, historically, which means prior to 2009 and the onset of central bank-supported equity markets, bond markets, and commodity markets, these things tended to react to each other in a more or less logical fashion. In other words, if the economies were doing well globally, then equities rose and so did interest rates on bonds, while commodity prices also typically increased, reflecting industrial and consumer demand. Now, as we go into the first week of October and the fourth quarter, we're seeing strange things. Equity markets are still generally rising but flattening out. Bond market yields, including sovereign bonds, are very low and not rising along with the equity markets. For example, U.S. Treasury yields have only been lower than they are now twice in U.S. history. And of course, commodity prices have been dropping, reflecting decreased demand more than reflecting increased production of these commodities. Simply put, the bond and commodities markets are signaling a global economic slowdown, which is not yet being matched by the stock markets. Now, many pundits maintain that it is the bond market signals that are the most important, and I tend to agree, given that the bond markets are A, much larger than the equity markets, and B, it is the bond markets, especially the junk bond markets, that are a primary driver of stock increases as they provide the funding for these corporations, and particularly over the past couple of years, the funding for the corporate stock buybacks that have sent share prices to these lofty levels. High volume selling, low volume buying. As we have discussed in the summary previously, market trading volume is a key indicator of the strength of either rising or falling stock prices, as volume reflects generally how many investors are either buying or selling. Now, on that note, look at this chart of the S&P 500 index for this week. Specifically, along the bottom of the chart is what we call the relative trading volume for each day. Note that relative volume increased each day as stocks were sold off, then declined from midday Thursday and into the Friday rally. The red on Friday, by the way, indicates a negative relative volume. Simply put, there seems to be a lot of investors selling, but significantly few investors buying the dips that drive the prices back up. So in my view, this indicates a very low level of broad investor confidence that the markets will keep rising. So, is the bond market correct? Is a trend reversal underway? Well, let's look at another chart of the S&P 500 index, this one provided by Gebhardt Group and 401k Masters. In looking at the broad one-year chart here, we see the index has remained in a trading corridor or range for the past 12 months. Now, the upper right corner of this chart is very telling on 2 points. First, note that despite the Friday rally in which the S&P gained over 1%, the index still closed below its 100-day simple moving average. That's that yellow squiggly line. And secondly, and perhaps more importantly, by Thursday, it had closed well below its trend line. Now, to many investment pros, this is a definite caution signal. So, what do our investment pros over at Gebhardt Group and 401k Masters think? Well, at market close, we talked to Matt Grishman. See what Matt had to say.
Thanks for having us again on this week's Saturday Summary. You know, John, you've really nailed it. The markets are back at it again. After a long, somewhat steady bullish climb throughout 2014, a series of geopolitical events sent most global market indices into a spiraling decline as the third quarter came to a close. Until the final week of the third quarter, volatility had been minimal for most of the year. In fact, our primary long-term indicator for our advance and protect strategy, which most heavily dictates whether we advise 401k Masters members to be fully invested, partially invested, or completely in cash, has been positive since the end of 2011. Advance and Protect is driven by three indicators: long-term, intermediate-term, and short-term indicators. For the first time since the fourth quarter of 2011, two of our three indicators have gone negative, signaling to us the likelihood of a more significant reversal in global market trends. As a result, this quarter we notified our members in their quarterly recommendations to take a much more defensive position within their own 401k, 403b, or 457 plans. And although every member's recommendation is really customized to his or her own fund choices and their specific tolerance for market risk, every 401k Masters member has been advised to bring equity exposure down considerably. After implementing our quarterly recommendations, every 401k Masters member should now be partially invested inside their 401k, 403b, or 457 plan. Thanks, John.
Well, again, that was Matt Grishman, a wealth advisor and partner at 401k Masters at the Gebhardt Group, both registered investment advisory firms. Well, as the article at page 5 is titled, "The Bells Are Ringing. Are you listening?" If you're retired or will be soon, is the prospect of perhaps an additional single-digit additional gain worth the possibility of a potential double-digit loss? We urge those nearing retirement or already retired to consolidate some of their gains to ensure their retirement security. As the 20th century financier and statesman Bernard Baruch famously said, "I got rich by selling too soon." Well, that's your Saturday summary. Have a great weekend. We'll see you next Saturday.